Welcome to TalkTickers. We're jumping straight into the Q1 2025 earnings call for TKO Group Holdings. That's the parent company for UFC, WWE, IMG, and PBR.
Yeah.
Our goal today, to really pull out the key takeaways and understand what's driving their performance.
And they certainly started 2025 strong. TKO reported results that actually beat their own internal expectations, both on revenue and profitability.
Okay, good start then. What are the headline numbers?
Well, first quarter revenue hit $1.269 billion. That's up 4% compared to last year. And adjusted EBITDA, that saw a really substantial jump, up 23% to $417 million.
Wow, 23%. That's significant. How's the margin look?
Improved. Came in at 33%. So yeah, a very solid quarter overall.
And this strong start, particularly from, the big names UFC and WWE, that's led them to raise guidance.
Exactly. They've upped their full year guidance for revenue and adjusted EBITDA, though that's excluding the impact of the recent acquisitions for now.
Okay, but what's the updated guidance, including everything IMG, On Location, PBR?
Right. So including those, they're now projecting full year 2025 revenue somewhere between $4.49 and $4.56 billion. And adjusted EBITDA is expected between $1.49 and $1.53 billion.
Okay, let's get into the weeds bit. Starting with UFC. Revenue up 15% to $360 million. What fueled that?
A huge piece of that was live events and hospitality. That segment jumped, get this, 66%.
66%. Where did that come from?
Primarily higher site fees. They specifically mentioned the Saudi Arabia Fight Night as a key contributor. Plus, they just had more events with live audiences, including 2 more international shows compared to last year. It really shows that global demand, doesn't it?
Definitely. And it wasn't just the events themselves. Partnerships played a big role, too.
Absolutely. Partnerships and marketing revenue climbed 32% to $64 million. That reflects new deals, renewals, and importantly, the largest sponsorship deal ever in UFC history with Monster Energy.
Monster Energy, right. And there was something with Meta, too.
Yes, a pretty groundbreaking multi-year partnership with Meta focused on immersive content experiences. So they're clearly diversifying how they connect with fans and partners.
Makes sense. And media rights.
Media production and content revenue was up a more modest 4%. That's mainly due to the built-in contractual increases in their existing media rights deals.
Okay, turning to WWE. There's a really strong showing there, right? Revenue up 24%?
Yeah, $392 million for the quarter. And adjusted EBITDA grew even faster, up 38% to $194 million, giving them a 50% margin. Really impressive.
And similar drivers? Live events?
Very similar story. Live events and hospitality revenue increased 52% to $76 million. Ticket sales were incredibly strong enough to more than offset a timing difference in site fees. Remember, last Q1 had that big Elimination Chamber event in Perth, Australia.
Ah, right. But the partnership growth for WWE was even more dramatic, wasn't it?
It really was. An 86% increase in partnerships and marketing revenue, hitting $26 million. Just a raft of new and renewed deals across different sectors. And they mentioned WrestleMania 41 is already setting all-time records for partnership revenue.
That's incredible. Shows that the brand power is still massive. Yeah. What about the media side for WWE? The Netflix deal starting to show.
Definitely. Media production and content revenue was up 14% to $252 million. That reflects SmackDown's expansion, but also, crucially, the start of that huge long-term agreement with Netflix. That's for Raw in the U.S. and all WWE content internationally on the platform.
And are they seeing traction on Netflix already?
Seems so. They reported strong engagement, good viewership increases, particularly highlighting markets like Mexico, the UK, Australia, Brazil. And India is now part of that Netflix footprint, too.
So early positive signs for that big bet. And the live events themselves, beyond the revenue.
Just crushing it. They reported 35 individual market records for ticket sales, 17 events completely sold out. Events like the Elimination Chamber in Canada and the Royal Rumble set records. Royal Rumble was actually the highest grossing non-WrestleMania event ever.
Wow.
And even the Road to WrestleMania tour in Europe, every single one of those 12 events set gate records. And WrestleMania 41 in Vegas, breaking records across the board already.
Okay, so UFC and WWE are firing on all cylinders. Let's shift to IMG. The numbers there were down a bit.
Yeah, revenue decreased 13% to $476 million, and adjusted EBITDA was down 10% to $74 million, margin at 15%.
What was the main reason for that dip?
It really came down to timing, specifically for On Location's big events like the Super Bowl and the college football bowl games. The specific venues and team matchups compared to last year impacted when and how revenue was recognized.
So more of a quarterly fluctuation than a fundamental issue.
That seems to be the explanation, yes. It highlights the event-driven nature of that part of the business.
But IMG did lock in some important deals, didn't they?
They did. Major renewals, like with CONMEBOL for South American football, EuroLeague basketball, that one's extended way out to 2035, 36, and also Major League Soccer's deal on Apple TV.
And On Location, despite the timing impacting the quarter, still active?
Very active. Delivered over 32,000 fan experiences. They mentioned Super Bowl 59, which is the first year of a new long extension with the NFL that runs through 2036. And interestingly, even with IMG's overall dip, the On Location hospitality revenue specifically for WrestleMania 41 was actually up 75% compared to last year.
75%. Okay, so bright spots even within that segment.
Uh-huh.
What about PBR? It's kind of tucked away in corporate and other now.
PBR showed some growth in live events and partnerships, which is positive, still drawing crowds. But their media rights revenue took a hit because that deal with Merit Street Media ended early.
Okay. Still drawing fans, though.
Yeah. The Unleash the Beast and Velocity tours apparently drew about 640,000 fans across 40 events with over 30 sellouts. So the core fan base seems engaged.
It sounds like bringing all these pieces, IMG, On Location, PBR, together with UFC and WWE is a major focus. How's that integration going?
They say it's well underway, and they're starting to see some early benefits. They pointed to an event called the TKO Takeover in Kansas City as an example of their unified live event strategy in action.
And cost savings, synergies.
They've identified over $40 million in estimated annual run rate cost savings from bringing these businesses together, and they expect to actually realize about $15 million of those savings here in 2025.
$15 million this year. Okay. How are they thinking about the wider economy? Any concerns about the consumer?
They said they're paying close attention naturally, but they're not seeing any real signs of a slowdown across their different businesses right now.
And things like tariffs, does that impact them much?
They feel they're largely insulated, mostly because for WWE and UFC consumer products, they rely heavily on licensing models rather than direct manufacturing and import.
Right, that makes sense. Okay, let's talk cash flow and capital structure.
Right.
How did free cash flow look in Q1?
They generated $136 million of free cash flow. That's a conversion rate of about 32% of adjusted EBITDA.
But were there any unusual items affecting that number?
Yes, quite significant ones, actually. Free cash flow was negatively impacted by about $175 million in non-recurring payments. That relates to the UFC antitrust settlement and some M&A costs.
Oof, $175 million.
Yeah, but offsetting that somewhat, they also received about $100 million in prepayments related to On Location and the upcoming 2026 FIFA World Cup.
Okay, so some big moving parts there, and they started paying a dividend.
They did. The first quarterly cash dividend, about $75 million, was paid out at the end of March.
And the big share buyback program they announced, still happening.
Still expected, yes. That $2 billion share repurchase program is anticipated to kick off sometime in Q2 or Q3, though they did emphasize the timing is subject to market conditions. They're taking a, quote, prudent and conservative approach to capital allocation right now, given market volatility, but remain committed to the capital return program.
Okay, now TKO also made some news with new ventures. What caught your eye?
Two big things. First, they're launching a new boxing promotion. They've entered a multi-year partnership and will serve as the managing partner.
A whole new boxing league.
Essentially. The plan is for roughly 12 fight cards per year, plus maybe 1 to 4 big super fights. They mentioned the Canelo-Crawford fight as the kind of super fight they're envisioning.
Interesting. Will it be called TKO Boxing?
No, they explicitly said it will not be called TKO Boxing and the name will be revealed soon. Also important. The super fights are funded separately from the main joint venture boxing organization.
Got it. And the second new venture?
They announced the acquisition of AAA Wrestling down in Mexico.
AAA, okay. Why Mexico?
They see it as a really significant opportunity, tapping into that large, young Hispanic market. The idea is to leverage WWE's know-how to boost media rights value, live event revenue, partnerships, and consumer products for AAA.
Big potential long-term, even if it doesn't move the needle financially right away.
Exactly. They said the short-term financial impact isn't expected to be meaningful to the overall TKO guidance, but it's a clear strategic play for growth in a key market.
Okay, one of the biggest questions hanging out there is the UFC media rights renewal. Any news on that front?
Not really any firm news. Discussions are ongoing, is what they said. They're talking to various third parties. They described the talks as thoughtful and strategic, and they made sure to mention ESPN is still very much in the mix as a valued partner.
So no announcement yet. What's their general approach?
It sounds like they're trying to strike a balance between maximizing the financial return, obviously, but also ensuring broad reach for the UFC brand to keep growing it. They seem confident, though. They view the market for sports rights as strong, and they keep highlighting UFC's advantages: year-round content, global appeal, and that desirable young demographic.
Makes sense. So wrapping up the guidance themes for the year, raised guidance for core TKO, that's UFC and WWE, driven by the Q1 outperformance.
Correct. Strong live events, strong global partnerships in Q1, and they see those positive trends continuing. The updated full-year guidance we discussed earlier now also incorporates the expected contribution from the acquired businesses IMG, On Location, PBR. But it also factors in some one-time corporate cost allocations from Endeavor, the cost synergies they expect to realize, and importantly, the loss of that PBR domestic media rights deal with Merit Street.
Okay. And looking just ahead to Q2, what should we expect?
For UFC, 11 events planned, 4 of them numbered PPVs. They expect a meaningful site fee for a fight night in Baku, Azerbaijan, but they noted it'll be a tough comparison against last year's Q2, which had that big Saudi Arabia event fee.
Right. And WWE.
Q2 is actually expected to be WWE's highest quarter for both revenue and adjusted EBITDA. That's mainly due to event timing, including WrestleMania falling in Q2 this year, plus another Saudi Arabia PLE.
And IMG. Super Bowl was Q1, so Q2 will likely be down.
Exactly. IMG typically has its strongest quarter in Q1 because of the Super Bowl, so expect a sequential decline in adjusted EBITDA there. Also, they mentioned that pre-spending for the Milan Olympics program will start hitting IMG's EBITDA and margins negatively for the rest of the year.
Okay, good context. So, stepping back, what's the overall picture for investors looking at TKO after this call?
Well, the strong Q1 and the raised guidance definitely signal positive momentum, especially in the core UFC and WWE segments. That's clear. Key things to watch going forward will be the successful integration of IMG, On Location, and PPR, and whether they can actually deliver those cost savings they've targeted.
And the growth catalysts?
The ongoing UFC media rights negotiation is obviously huge. That outcome will be significant. The development of the new boxing venture is another potential growth driver, as is the AAA acquisition in Mexico, showing that focus on international expansion.
And the risks. Macro economy.
Management acknowledges the macroeconomic uncertainties, yes, but the current strength they're seeing in live events and partnerships provides a degree of resilience, it seems.
What about capital return?
The start of that share repurchase program will definitely be a key focus for investors wanting to see those capital returns begin. Overall, the market seems to value TK's collection of assets and their management. There's confidence there. But the question remains, maybe, about sustaining high growth after the next round of media rights deals are done.
How are they addressing that concern?
Management is really emphasizing other growth levers.
Yeah.
Pushing harder on global partnerships, growing live ticket revenue, developing these new properties like boxing, and continuing that international expansion drive. They believe there's still plenty of runway for exciting growth.
All right, that brings us to our This Is Not Financial Advice segment. Time for some creative thinking based on the call. What's an outrageous but plausible trade idea you've got for us?
Okay, how about this? We talked about the positive early signs from the Netflix WWE partnership, right? Especially internationally in places like India and Brazil. So maybe consider a long position in Netflix itself. The bet would be that the market is underestimating the long-term stickiness and subscriber growth WWE content can drive for Netflix in these crucial international markets. It could be a bigger catalyst for Netflix's global growth than currently priced in, but again, definitely not financial advice.
Interesting play on the content partner. Okay, I've got one too. TKO is clearly pushing hard for those big international site fees. Saudi Arabia, Azerbaijan mentioned, the Australia deal as a blueprint. So maybe look into publicly traded tourism companies or even ETFs focused on regions that are actively trying to land these kinds of TKO events. Hosting a major UFC or WWE event could provide a really significant measurable boost to local tourism and related businesses in those specific locations. Might be an indirect way to play TKO's global event strategy, but of course, not financial advice.
That wraps up our deep dive into TKO's Q1 2025 earnings call. We've covered the financials, the strategies, the new ventures, and even a couple of wild ideas.
Yeah, hopefully this analysis gave you a much clearer picture of where TKO Group Holdings stands and where they might be heading. As always, do your own research, form your own conclusions.
Absolutely. Thanks for tuning in to Talk Tickers. We'll be back soon with another deep dive into the world of earnings.